And it is Saturday, and we're talking about money. U.S. Treasury securities are the most traded in the world. They trade 24 hours a day, 7 days a week, 365 days a year. They never stop trading, but it wasn't always that way. There's changes that are underway that can make significant differences, and you as an investor should understand what's coming. We're going to give you some ideas as to where we're headed and what's happening, but we want to go all the way back. Following the Revolutionary War in 1790, the government was issuing bonds, just like governments issued today and in France and England. But those bonds, even though Hamilton wanted them to carry the full faith and credit of the U.S. government, George Washington wanted to set up the first national bank of the U.S., those government bonds were trading for a value of less than the interest payment. They were trading for 20 cents on the dollar, where the interest payments were over 8%. So Hamilton wanted a deep and liquid market. And if we have anything today, he got what his wish. He wanted the government to honor all debts, a full faith and credit situation. There were a lot of others who argued that speculators should be paid less than face value, but Hamilton made the comment that it was the credit of the country at risk. You know, when you think about it, and today what's going on with the debt limit and not increasing and talking about shutting down the government, that shuts down the Treasury. But even way back then, Treasuries, Hamilton, and Washington wanted a full faith and credit. The currency at that time was different than it is today. The currency was specie. And in fact, the Constitution specifies that the currency is specie. And what does specie mean? That's gold or silver, or in some cases, copper or lead, but mostly gold or silver. Coins that had a certain value, $1 worth of silver in that coin. I grew up hearing the name 2 bits, 4 bits, 6 bits a dollar. Never knew where that came from until a few years ago when I read an article about what that was. They used to take the dollar coin, the dollar silver coin, and cut it into 8 pieces. So you cut it like a pie. So you had 8 pieces of silver. Each piece was 1 bit.
2 bits was a quarter, Mike.
2 bits was a quarter.
I learned that early on. I used to work. My family was in the hair business, and I had to start in the business. So as a young kid, I did, and I was working with all these old timers, World War II guys.
Yep.
And when I was probably 15 years old, and that's all they talked about. This used to be 2 bits, and that was 4 bits. I'm like, a bit? What the heck are they talking about? And finally, I asked my Jerry, what's a bit? Oh, a bit? That's 2 bits? That's a quarter.
Yeah.
Why don't these call it a quarter? These guys like to call it 2 bits.
And 4 bits.
Yeah.
Is half a buck.
Yeah.
I mean, that's what it was. So during the time of George Washington in 1791, under Hamilton, the United States government formed the first national bank of the United States. It was like the Federal Reserve. The idea was that as money came into the government, they would deposit it in the first national bank of the United States. And when they needed to transfer money out in terms of specie, they would transfer it out. The first national bank of the United States was a depository and a bank for the U.S. government. And formed in 1791, it had a 20-year charter. It was to last for at least 20 years, expiring in 1811. And it did expire in 1811. And for a period of 5 years, they just banked here and there and everywhere. So in 1816, they formed the second national bank of the United States. If every bank had a 20-year charter today, we would be working on what? The 40th National Bank of the United States? But before that second national bank charter expired, there was an election that took place in 1825, which was to have a significant impact on banking. The voting went, and no one received a majority of the votes. So the whole election was thrown into the House of Representatives. That's the way it's represented in the Constitution. We got a taste of that in 2020. Mm-hmm. But it went into the House of Representatives. And there were 4 candidates. By popular vote, Andrew Jackson led, and he had 99 representatives committed to him. John Quincy Adams had 84. Henry Clay from the South, who would play a significant role in the Civil War, 37. And William Crawford, who was a former Treasury Secretary who had replaced Alexander Hamilton once or twice removed, had 41 votes. And Crawford was a logical compromise. There was a focus to push Crawford into the presidency. But lo and behold, he had a stroke and he fell behind. So Clay threw his support to Adams, and he encouraged the Crawford representatives to do so as well. And thus it was that John Quincy Adams became president of the United States, because Crawford had a stroke and Clay preferred Adams to Jackson. And Jackson's people never forgave that. They killed almost every bill. Just say no, whether it was good or not. They just killed almost every bill except for one, which was called the Tariff Bill, called the Bill of Abominations.
Abomination, Mike.
Abominations. There we go.
It was that bad.
What it did is it protected the northern states from imports from Britain. It was a nationalistic kind of thing. And it forced the southern states to buy from the north or to pay higher prices. It became a significant factor in what became in the Civil War. But when Jackson was elected president, there was an overhanging debt from the War of 1812. That debt represented 70% of GDP. And Jackson set out to pay off that debt. He put tariffs on products coming into the United States, just like the imports from Britain, and he started selling land in the West, because remember, that was the great look west, young man look west. But Jackson also had a problem with the Second National Bank. He didn't like the bank because he thought it was set up and being handled by wealthy people instead of common people. And he didn't like the leader of the bank or the board of directors. And he wanted to see that paper money, because now they were beginning to print notes on paper. They weren't backed by gold or silver. And while we were in a booming economy, Jackson wanted all the paper notes being produced by the Second National Bank of the United States to be backed by either gold or by silver. And the economy at that time was booming. We were building canals. There was a land boom, cotton, manufacturing. But Jackson didn't like the Second National Bank of the U.S. He tried to get it dissolved in Congress. That didn't work. So what he did is he just simply withdrew all the federal funds from the Second National Bank, and he refused to put money into the Second National Bank. So essentially it had zero assets. And instead, Jackson put the money out to what were called pet banks. And during that time, with that bank not existing, the government having no control, you had the first Great Depression of 1837. And there was no Federal Reserve. There was no central bank. There was no way for the government to stimulate the economy. The economy simply collapsed. And there wouldn't be a Federal Reserve until 1913. But from 1837, it started a new time of what was to be known as the free, or what we know today as the free banking era. Congress allowed everybody to form a bank. And there were over 1,500 banks. And those banks began to print paper money. They printed dollar bills, and all traded at a very discount from par. Can you imagine today getting a $10 bill that was printed by Washington Fed that you could only trade for $9.90? And if you had one from the Bank of America, it was only worth $9.40. A $10 bill from the Bank of Oklahoma was only $7.70 when you tried to buy something. That was normal. There were brokers that were trading those banknotes, and it depended upon the stability of the bank, because a lot of banks went under and left the depositors with nothing, left people who had that paper with nothing. So it depended upon how far away and how stable the bank was as to what the bank paper was worth. And the banks had to keep some reserves, but not a whole lot, not enough to cover. And so from 1837 to 1863, That's how dollars were handled. 1,500 banks issued their own dollars. Think about it. Think about being in Seattle if you had a Bank of Oregon. If you didn't know
or a Bank of Virginia. A bank, you traveled out here and you had notes from a Bank of Virginia.
Yeah. I mean, that dollar might only be worth 60 cents.
Yeah.
That's what it was coming up to the Civil War, 1861. And in that war, the Civil War, it was another huge change. We're coming to a commercial break. Don't go away. I want to continue this because we started talking about treasuries. We're going to get there because treasuries first happened at the time of the Civil War. Don't go away. We'll be right back. We've been talking about treasuries, the most traded security in the world. How did we get to there? What happened? That's what we're talking about today. So we got to the Civil War. 1861, the Civil War breaks out. And to finance a war, it doesn't finance itself, as we've seen with the Ukraine, with Israel. Money has to pour in to buy the munitions, to pay the soldiers, and to do all those things. And at the time of the Civil War, it was costing the U.S. government, the North, $2.5 million a day. That was huge money in that time. And to finance it, the U.S. government initiated a sale of U.S. Treasury bonds. They were not full faith and credit, and they didn't have worldwide backing. They couldn't get France and England to buy those bonds, but they were selling them to people in the U.S. And $2.5 million a day, that's a lot of money. There weren't enough buyers of those Treasury bonds, so the U.S. government came up with the idea of selling paper currency. They printed the paper, the dollars were printed on green paper, greenbacks. So came the expression of greenbacks. They weren't backed by gold or silver. They didn't have the full faith but they had the full faith and credit of the U.S. government. The greenbacks did. Arguments broke out in Congress because the Constitution specifically said coinage, not paper, coinage. Nevertheless, to finance the debt, by 1865, the debt had grown from $64 million in 1860 to $2.2 billion. That's more in terms of GDP than we have today at a $30 trillion debt. That's what happened from the Civil War. But they also needed a means to finance and bring revenues into the government. So they came up with this idea of the Internal Revenue Service. So not only did we get treasuries out of the Civil War, not only did we get greenbacks out of the Civil War, we got for the first time the Internal Revenue Service. Just fill out the form and send the money in. The idea was to pay down the debt. That was the reason to create the IRS. And in fact, they did. They reduced the debt from $2.2 billion in 1865 to $1.5 billion in 1890, even experiencing one after another financial crisis. Between 1874 and 1907, they experienced 6 financial crises, equal to what we see as 2007, 2008. But the financial debt rating was, in fact, downgraded, if it could be downgraded, if there was a credit agency, until the Federal Reserve was formed in 1913. And at that time, it was recognized that Hamilton and Washington were correct when they said the treasuries had to be developed by the full faith and credit of the U.S. government, and you had to pay them off at face value.
But that didn't stop the Great Depression, didn't stop 2007, 2008, right?
No.
And interesting that we had all those problems before, but it didn't stop any of those problems from happening again.
And it won't stop the next one either.
No, it won't. No.
I mean, that's a function of the free economy. It's like a pendulum. It swings from one side to the other.
Yeah, but the whole goal was in 1913, it wasn't necessarily just to stop that, right?
Yes.
We know that J.P. Morgan helped them bail them out in 2007, and they had about $100 million in debt, and he lent them $60 million. Because they didn't
1907,
want,
yeah.
1907. They didn't want it because they didn't want to borrow the whole $100 million from him. They didn't want one guy to have that much power. That's where they kind of said, maybe Washington was onto something.
So moving forward, not a lot. We had a Great Depression. We had the 20s and the Great Depression. But it wasn't until World War II, and when the war came to an end, there was a lot of concern worldwide. We'd had a Great Depression, and the economy and the war were in everybody's mind. And so, to prevent another world war and another economic collapse, there was a meeting called between the primary countries of the world. The IMF was formed, the World Bank was formed, an organization more than the WTO was set up. The dollar was set upon as the world currency. The United States was there, and we had at that time a large trade surplus. The UK, whose currency had been the currency of trade up until World War II, was a big debtor nation. The UK sent John Maynard Keynes, the US sent Harry Dexter, and the United States essentially dominated the meeting. And that meeting, initially 5 nations, the United States, Britain, France, Germany, and Japan, the decision was to rebuild the world and to use the dollar as the currency of preference. That meeting was followed by Bretton Woods with 44 countries, lasted 22 days. From that came the International Monetary Fund, the GATT, the World Bank.
General Agreements on Tariff and Trade.
Yes.
To be specific, Mike.
You're right. And since then, the world economy has grown and strengthened. The G5, those 5 nations, the U.S., Britain, France, Germany, and Japan, were expanded to 20, including nations like China, Brazil, and Russia. And while they questioned the dollar's dominance in the last few years, the dominance because the dollar was traded, we became a debtor nation instead of a surplus nation. And the UK, a former big debtor, was a nation that moved to the sidelines. When you look at where we are, the United States is over 20% of the world's GDP today. At one time, we were almost 50%. American fund managers manage 55% of the world's assets. The Treasury is backed by the full faith and credit of the U.S. government. When you compare the liquidity of the dollar to the Swiss franc, the dollar has absolute liquidity compared to the Swiss franc. The financial system is based on the dollar. Foreign countries carry their reserves in dollars, and there's contracts between companies. Almost all of those contracts are set in dollars. 150 different currencies, all converted into dollars. And for trading with one another, there are now 11,175 exchange markets, from banks to broker-dealers to individual trading organizations, but almost all trade, over 95% of trade, is in dollars. Every international bank keeps accounts in New York, and they transfer funds through the hub in New York. Jarrett Blank of the Carnegie Endowment for International Peace, and I quote, "The global financial system is like a sewer, and all the pipes run through New York." The U.S. Treasury has a complete jurisdiction, and The Economist in 2018 pointed out that the excluding a country or a company from the U.S. economy or from the U.S. dollar or treasuries is one of the worst things that can happen. The U.S. system actually has we trade $4.5 trillion per day in the exchanges. That's the size of all of this. And all of that now sets the stage for things that are about to change. Significant things. There's a lot of concern right now because the United States has a debt of over $26 trillion.
I think it's 30 trillion.
Is it 30 trillion?
And it's going to go up again because they're going to raise the debt ceiling after the first of the year.
That's true.
So it'll probably be somewhere around 33 trillion by then.
It's more than double what we had 10 years ago. 10 years ago, we had 12 trillion. That'll be 2.5 times.
Yeah.
3 times what we had. Another day to discuss. But it really bothers me that we have a booming economy and we're running a $2 trillion deficit. where is everybody? Where is this administration? Where is the Senate? Anyway, we have to dig into that in another day. We're talking about treasuries today. We're talking about how we finance that. The interest expense is now running at over 20% of government spending, and it's growing. And if interest rates continue up the way they are, it could be to grow even more. Our $30 trillion represents almost 100% of our GDP. And compare that to 2013, $12 trillion worth of debt was 71% of GDP. With that background, there's always talk of who holds the U.S. Treasuries. We always talk about China having the leverage. Actually, two decades ago, foreign governments had 50% of the treasuries. Today, it's 24%. Japan has 3%, China 2.7%, the UK 1.8%, but 76% of the treasuries are held by U.S.-based endowments, hedge funds, individuals, banks, and broker-dealers. Don't go away. We've got more to discuss because we're just beginning to touch on what is about to happen in the treasury market, something that you as an investor should know and understand. We'll be right back after the commercial break.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
Treasuries traded 24 hours a day, 7 days a week, 365 days a year, the most traded security in the world. $4.5 trillion traded every single in terms of dollars and dollar contracts and treasury contracts. The market, however, is being strained. There was a time in which foreign governments owned 50% of the treasuries. Today it's 76%, and that has become a real issue because the market is truly being strained. Leveraged hedge funds are the latest example. Computer algorithms switching between buying treasuries and cash and buying the futures contracts on treasuries. Very, very small movements. And the difference between the future market and the cash market in terms of treasury, very small increments of 1/10%, a half a tenth of percent, a tenth of a tenth of a tenth percent. Those small movements, yet the difference between the cash and the future market, computer algorithms are set to take advantage of that. And they don't trade in small amounts, they trade in huge amounts. And oftentimes they're leveraged as much as 50 to 1. So think of that. If you want to do a $1 billion trade, they only have to put up $20 million to $1 billion. If the market moves against them, not only do you wipe out the $20 million, you could wipe out $100 million, meaning leaving them $80 million underwater. And where do they get the money that if for a $1 billion trade, they only have to put up $20 million? Where does the $980 million come from? Banks. Banks are making the loans. And so if the example, which I use as an extreme, there wouldn't probably be that. But if they buy if they make a $1 billion trade and put up only $20 million and it moves against them and they have an $80 million loss, it's the banks that get hit. While the hedge fund may have to put up the $80 million, if they have enough equity, they can do that. But if not, the bank gets hit. And we've seen in a number of cases where banks actually have gotten hit. In 2014, there was a flash crash where yields went crazy and banks started margin calls. In 2019, there was a spike in interest rates in the repo market and you had a fire sale. That same thing happened in 2020 when the market was overwhelmed with people trying to sell and get rid of their treasuries. Actual fire sale went on where they were trading at significantly below cost. So that when I talk about $1 billion and only putting up $20 million and losing $80 million, that's what happens during a fire sale. And there's not time to make a sale of the $20 million or $40 million or $50 million down. The fire sale happens and the movement is so rapid and so fast with computer trading that you end up really dislodging. So with the U.S. Treasuries being the bedrock of global finance, there's a lot of concern. And the regulators are beginning to move in to take care of that. And their biggest proposal, one that's getting a lot of pushback, a huge amount of pushback, is they want a central clearinghouse. So the central clearinghouse would be the buyer from all sellers and would be the seller to all buyers. Every single transaction would go through a central clearinghouse. There would be only one exchange. Today, there's 11,175 exchanges. Under the proposed rule, there would be one. Think about that. Currently, what the system is set up to do, you have primary dealers. You have banks and broker-dealers who are in the auction when treasuries are actually sold by the Treasury Department. It's the primary dealers, the banks and the broker-dealers, who step in and they will bid for the treasuries. And that sets the new yield rate. Those dealers, those primary dealers, then sell to customers. They sell to foreign investors. They sell to hedge funds, to pension funds, and to firms, and money market funds. And all of that is a fairly small number. But those dealers selling to customers sell to a huge majority of those 11,175 exchange market, in addition to those individual customers. Most of the customers are secondary market, and they include the high-frequency traders that are using algorithms. They include future market and cash market, and often those are the people that put up only 2% and finance 98%. And every one of those 11,000, plus some of the customers and the hedge funds, can be a link that brings down the chain. You know, not that many years ago, we talked about long-term capital, right?
Mm-hmm.
Just one hedge fund could have brought down the entire financial system. And they were not even trading treasury market.
No, they were trading currency, a lot of currency markets. And they made a miss on their big swing and miss was on the Russian ruble.
Yep.
And Alan Greenspan and the boys had to go in and bail them out.
And had to force the banks to step in and loan them more money.
Mm-hmm.
Otherwise, they would have liquidated that entire thing at fire sale prices.
Mm-hmm.
Already, they've been making 15% per year, and they've been doing that for several years. When the ruble was devalued, they lost their entire equity, and they were underwater by 20% or 30%.
I don't know the percentage.
I can't remember. That was 1998.
Yeah, but it was about 4 years before that. They also had the crash in the Mexican peso that sent markets going crazy too.
Yep.
And then they had the crash in the Asian crash, which also sent markets. Was that in no, not Indonesia. That was I can't remember, Singapore. Somewhere in Singapore, was it Singapore? Somewhere in there that they had a terrible Asian crash. So
those things happen. So this sets up one primary dealer.
And that goes into, what they're thinking about, Mike, is setting up a central CBDC, central bank digital currency, and how that affects the treasury markets, because it's going to have an effect on the treasury markets.
Sure.
So think about it this way. Right now, when people go to safety, they go to short-term treasuries and go to money markets. Now, if we have a central bank digital currency, because it's got the full faith and backing of the U.S. government, and money markets can somewhat, be susceptible if we do have a crash. And there's a little risk to the treasuries. They're saying that the effects could be that the people will pull their money out of money markets in short-term treasuries and put them in the digital currency because of the full faith, and that could reduce liquidity in the markets and cause more problems.
Yep.
That's just one of the problems with the central bank digital.
And you have no arbitrage ability.
Mm-hmm.
You have one central bank.
Yes.
And think about the power, economic power that brings to the United States.
Well, think about it from a perspective of how many people are going to be worried about their privacy, right? That the government can come in and just shut you down and shut down the flow of currency. And the other thing I think about, though, is the efficiency it could be, right? If it's done right, wouldn't it abolish the IRS if we have a ledger on either side? We don't need the IRS. We don't need the Washington Department of Financial Service, Department of Revenue. We don't need Seattle's B&O tax. Everything can be done on ledger, and they can just take a snippet every day or every week of our money off of these digital ledgers of these blockchain.
And it could be that
efficient.
Could be that old joke about the IRS, the new form. It says, how much money did you make? Send it in.
But no, think about how it would be, how efficient. They would just know what you owe, and it'd be easy, and we could calculate, and it wouldn't be this whole system of filing all these taxes and filing all these forms to figure out how much you owe in taxes. It'd be so easy to know all that.
And it would be easy for them to collect money instead of once a year and with quarterly payment, to collect it on a monthly basis or a weekly basis.
Or a daily basis, if it's
or
that
a daily
efficient.
basis.
Yeah. But it costs the transfer. If I want to transfer, a bank's transferring money to overseas, the average cost is like 5.41%. They estimated. This is straight from the Federal Reserve. This isn't me going and digging online. This is straight a whole 40-page paper from the Federal Reserve. Those costs would be dramatically reduced to transfer money overseas and transfer across, different countries.
Well, think about it. 11,175 exchanges.
Yeah.
Every one of those is making a profit. It cuts out all the costs. I mean, transfers of money, investment money, it's all low cost.
Right. And so, and they believe that it would bring a lot more people into the markets. I think they estimated the percentage, I'd have to find it, but how many people don't use banks in this country, just in this country, that are like fearful of banks, and that something like that could potentially bring more people into the banking system.
Sure, because the ledger would be at the central location.
You're right.
And all a bank is a place you have a ledger anyway.
The question is would it be, the big question is would the digital currency be interest-bearing or non-interest-bearing? If it's interest-bearing, that's where we end up with the problems, the liquidity in the money markets and short-term treasury. So something to think about. And
think about.
And there's a lot of, and this is coming. It's not like it's not coming.
It's not in the sky.
No, this is not just some thing I'm making up, or that's not something that's on the horizon in the next, say, 5 to.
So it's something for you to be aware of as the listener. The reason we talked about this is because the Treasury market has changed over 200 years, and it's going to continue to change. Stay with us. We'll come back. We've got more to cover right after the break.
Mike, you started off the show talking about the Revolutionary War and the evolution of central banking,
yes,
and how we got to where we are today. And so you can see that the government and the Federal Reserve particularly has kind of been on the pulse of making changes to make transactions cheap, less expensive, more efficient, and more try to bring more people into the system.
Correct.
And so it's like in the 1970s, the Federal Reserve developed the automated clearinghouse system, the ACH thing. So checks could be cleared, so you didn't have to wait for your check things to be cleared. And they recently developed is FedNow, a service which provides real-time, round-the-clock interbanking payments every day of the year, 24/7. These things happen. So the Fed is on top of trying to make things more efficient and bring more people into the system. It's not something, what you're talking about, it's not something radical and new that they're doing.
No, but it is something that is taking place. It is going to.
Right. Here's the other problem with it, though, Mike. This is as much a financial decision as a political decision, because it has to be ratified through Congress.
Yep.
And we know how fun that's going to be. As close as all those congressmen are with each other, right?
So way back then, I did a couple of radio programs, and when they were trying to pass Dodd-Frank, in response to 2007, 2008.
Yeah.
And somebody had put together a survey or a study showing how many letters had been written on a positive side and how many had been written against Dodd-Frank. How many in-person meetings were on the positive side and in-person meetings on the negative side. And it was like 17,000 letters had been written for a positive for Dodd-Frank and a couple hundred negative. But in-person meetings, there were like 10 in-person meetings positive and 500 in-person meetings by lobbyists negative.
Yeah.
And the big push was negative. There were a lot of things that were cut out. The SEC was supposed to come up with a fiduciary rule.
That got gutted.
I mean, there was so much pushback. And when the Department of Labor came out with the fiduciary rule, it went to the courts and was shot down.
Yeah, but all these regulations, I'm kind of like, I get irritated. I'm not for them, and I'll tell you why. It's because after the dot-com crash, and we saw WorldCom and Enron and all those things, they came up with Sarbanes-Oxley.
Yep.
All the CEOs have to ratify their financial statements. Their 10Ks have to be personally sign off. That ain't going to stop a company from, if their really goal is to manipulate their stock price or their earnings or their assets to look better.
And it has,
And
the principle of unintended consequences.
Yeah, and the amount of paperwork and bureaucracy that it creates and costs that it creates to do that. I mean, you and I still look at companies today and look at them and we read reports on what they're doing wrong. That doesn't make any sense.
We talked about this on a radio program. It's been over 10 years ago. And the person was a manufacturer.
Yeah.
And he said, the regulations are so onerous. He said, we manufacture, I don't remember, it's a widget of some sort. Anyway.
Yeah.
He said, we know it's finished when we put it on a scale and when it weighs as much as the paper does.
See that?
They have so many regulations.
Yeah, see that.
And, being in the financial services, being a registered investment advisor, we have to do, in order to sell stocks and bonds, our ADV is almost 200 pages.
Yeah, but go to FINRA and look at the people who still try to do things wrong.
Yeah.
I'm not saying anybody could have a dispute here or there, but when you see multiple, there's still people out there that want to try to skin the cat a different way.
And they do.
I know.
And
at my old broker-dealer, there was a guy over in Spokane that was doing it wrong, and they finally caught up with him after years, but nothing happened to him. He left the company, got to keep all his money, and went to open up a consulting firm to help people like RIAs make money. So, I don't know.
I agree. A lot of regulations are written that have a really good purpose, but nobody really thinks through all the consequences.
No.
And when they do find the consequences which they didn't understand were going to happen, then they pass a new regulation to take care of that.
I know.
And then a new one, and a new one, and a new one, and a new one.
I know. But back to central banks, 11,000 down to one clearinghouse. And, same thing with currencies, down to, the federal government issuing a digital currency. But that's not going to get, they even state that their goal isn't to erase all the other currencies. It's not to get rid of the paper dollars. Now, if they got rid of the penny, I think, I don't know why we even need the penny.
I am so old. I use paper money. And there's a lot of places that won't take paper money anymore.
No.
They require a credit card or a debit card.
There's some stats here on the digital, how the transition that we've gone from using paper to how many people are using, more and more people are just cashless. And it keeps growing and growing that the country's moving more towards, cash is just going to be not used unless a criminal.
And that's, it's going to work out. So with a digital currency, it's going to be much safer. But it's also going to be highly trackable.
Yeah, I don't know. A safety, I think that's a concern, is if someone did send a computer virus into a digital currency and could shut down the dollar and shut down the yuan and shut down some major currencies, they could really hold the world over a barrel.
Yeah. Cybersecurity is going to be ever, ever so important.
Yeah. So there's a lot of things that need to be ironed out before they make this move. But it's from what I read, it's a no-brainer that it's coming along.
Yeah.
And what will that do to the other cryptocurrencies out there? I don't know.
Who knows? When you have, it's going to be similar to the stable value currency.
You mean the stable coins? Yeah.
Stable coin.
Yeah.
Because it's going to be dollar for dollar.
Mm-hmm.
It's going to be in many cases like a check.
Yeah, but you won't have any transaction of fee, you won't be having any transaction fees in the way, taking a snippet of 2% or 1%. You stop at a cash machine, it costs you $2 to $4 to get $100 in cash. You won't have those issues will be gone.
It'll be gone.
So
there won't be cash machines.
No, they'll be gone. Yes.
You just step up, push your finger into a slot,
Yep.
It'll check your fingerprint and say, okay, you can put this amount of money onto your cell phone.
Yep. That's what it'll be. Yep.
Anyway, we're coming to the end of the program. These are big changes that are taking place. And these are things that don't get caught and blindsided by what's happening. We want to keep you informed. We want you ahead of the curve instead of behind the curve. That's the focus of this program, is to keep you ahead of the curve and not behind. So if you miss any part of this program or any part of some of the other programs, you can find them on YouTube. You can just look about money, look up about money, and you'll find this program and some of the others we've had. You can also look at our website. We have these on our website. And it's important to understand where we're going and why we're getting there.
And then, that we're, from our perspective, is looking at what's going to change in the financial world, of what companies are going to benefit, who's going to be making these products, and who's going to be developing these solutions that we can find the companies that are on the cutting edge to take advantage of and get in early.
And make sure we're out of those, which are going to be hurt.
Yes.
With that, have a great weekend and a great week. And if it's Saturday, we'll be back to talk about money
with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today, or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors.